Hi guys, Alex here. Today we are going to hear what Gene Munster has to say about Tesla in a great interview with Electrified. Let's watch.
I like that. So let's talk about PE ratios for a second. There's much discussion in the Tesla community about this. So do you use them still in this environment? And if so, and you had to pick one, whether it be the trailing 12 months or, a future fiscal year, how do you kind of think about PE ratios in your valuation of a company like Tesla?
When you think about transformative tech, you have to stretch out to a couple years out. Think about what the PE is going to be in 2 to 3 years, and that's where a lot of the controversy comes with investing in some of these emerging companies. And where I think of it in relation to growth too, that does matter. It's not just PE; you have to factor in some level of growth. So I think that a PEG ratio is relevant here. And of course, maybe to say it in a more plain English, is that I'm more comfortable at paying a 35 times multiple on something a couple years out if I think it's going to grow earnings at 40 or 50% versus pay 35 times for a company that's growing earnings at 5%. And so that is, it is important. It is a rift on this reverse DCF that I talked about. But ultimately, I think that is where a lot of these companies have burst. The bubble has burst. It's been just the lack of the lack of earnings, I think, has really caused the collapse of some of these valuations. And it's just a good reminder is it matters how much money companies make.
In the PEG earlier. So some people in the Tesla community will say just throw out PE ratios altogether and just focus on the PEG. So what would you say to that cohort?
I think PEG matters. I think that what you pay for a company relative to its growth prospects does matter. And so in the case of Tesla, I just kind of quickly think about this is they're probably in 2024 going to earn, my guess is $21, which puts it at right around a 35 PE on, it's a couple years out now. And I think they'll probably grow earnings that year at 40%. So when you put those two factors together, it says that the PE multiple should probably be more like 50, something like that, or 45. It feels like, or at least over the next 1 to 2 years, it's undervalued. Again, I think that there are some headwinds to the stock that are probably worth mentioning, but that's how I think about PEG. I think it does matter. I think growth does matter, especially in tech. And there's a very simple principle, which in tech is this will hopefully make and save you a lot of money, is the principle that if you're not growing, you're dying. And if you're dying in tech, there's really is no such thing as a value company when it comes to tech. Just ask Yahoo investors 10, 15 years ago. It just doesn't happen. eBay investors, you got to be growing, and that's a good principle. So growth does matter when it comes to valuing these. Therefore, the PEG matters.
Mm-hmm. So I know Loup is very big into AI and robotics. So how are you guys thinking about valuation when it comes to Tesla and full self-driving and robo taxis in the future? How do you think about that today?
We're really not factoring much of it in when we think about the opportunity with Tesla more broadly. When I think kind of 5 years out and think, again, not an investment recommendation, but my belief that this is ultimately a $2,500 stock. It's based on a multiple, mostly driven by just the underlying auto sales and the energy business. And I think when the auto sales obviously have an impact from FSD and that component, but it's not the adoption is still relatively low. The percentage of people that select those options is still relatively low. So we're still in the camp that is an additional growth driver. I would put what can happen with FSD. I think what insurance. I think Optimus. I think that all three of those are in a camp where this company could be a lot more, and this could be also the punchline to a joke, what I just said. That's why we don't put it in the model right now. It's because this is still so far out there. All three of those, even though they're two of the three have started a little bit with insurance and FSD, but I think collectively they're still far enough on the horizon that I'm just not comfortable underwriting that from an investment perspective, and hope that they get there, because if they do, that 2,500 base case is going to be conservative.
Yeah. So let's shift gears a little bit. How long do you think Tesla can increase deliveries 50% a year?
I'm surprised they've, as optimistic as I am about Tesla, I'm surprised they've kept it going at the pace that they have kept it going. But to answer your question, I think for a couple more years, and that would be just spectacular. But I think if you, once we start to get into 2024, maybe 2023, by 2024, we should start to see the law of numbers starting to catch up to those growth rates.
Yeah, I think it's 2026 where it starts to be like over a 3 million car per year jump, which would, obviously require a few more factories and things like that.
If you want to watch the full interview, you have the link in the description below. A couple of days ago, I posted a video about ARK Invest valuation model of Tesla and the potential future stock price. Click the card in the upper corner if you want to see it. On one hand, we have Cathie Wood ARK Invest Tesla stock price target of $4,600, taking robotaxi into consideration. And on the other hand, we have Gene Munster from Loup Ventures, $2,500. Here the valuation is based on auto sales and energy business only. FSD or robotaxi is not priced in. What valuation of Tesla stock is likely to pan out in 2026? Cathie Wood's price or Gene Munster's price target? Leave a comment below. If you like this video, please smash that like button for the YouTube algorithm and subscribe. See you next time.